All right, let's dive right into this explainer. Today, we're putting Howmet Aerospace through the ultimate valuation gauntlet. As an investment analyst, I'm going to walk you through a comprehensive, no-nonsense stock analysis of this aerospace titan. We're going to strip away all the market hype and use the exact battle-tested methodologies of Warren Buffett, Peter Lynch, and Benjamin Graham, along with a rigorous discounted cash flow and reverse DCF model to find this stock's true intrinsic value. Here's our flight plan for this high-altitude stress test. We'll start with a quick company snapshot, view it through the Buffett and Lynch lenses, hit the Graham lens, run our DCF valuation, look at market multiples, and wrap up with our synthesis and final verdict. Section 1. Company Snapshot. Let's get the absolute basics out of the way first. So, Howmet Aerospace, ticker HWM. These guys are an absolute titan in mission-critical engine components, fastening systems, and structural airframe parts. They serve the aerospace, defense, and even commercial transportation sectors. Honestly, if it flies, there's a very solid chance Howmet's advanced metallurgy is the exact thing keeping it in the air. And financially, they are dominating right now. The stock has been soaring, trading near $276, riding the wave of massive global aircraft backlogs. Just look at their Q1 2026 numbers. Revenue jumped 19% to $2.31 billion. They've got a killer net margin of over 20% and a staggering 29.27% return on equity. The business is literally firing on all cylinders. But here's the billion-dollar question. Is that stock price actually justified? Section 2. The Buffett and Lynch lenses. Quality versus growth. If we put on our Warren Buffett glasses, we're hunting for a wide economic moat, pristine management quality, high return on equity, and manageable debt. And honestly, Howmet passes these quality tests with flying colors. For example, their aftermarket spares revenue, which is incredibly high margin, just jumped 33%. That proves real pricing power. Add in that massive 29% ROE, an A- rating from Fitch, and sub 2.0x EBITDA leverage, and you've got a textbook moat. Now, Buffett famously relies on owner earnings rather than just plain old accounting profit, right? We're talking about the actual free cash flow a company spits out after maintaining its operations. For Howmet, this is incredibly strong. They generated $359 million in free cash flow in the first quarter alone, which paces them toward an estimated $1.4 to $1.5 billion annually. And management isn't just sitting on that cash. They aggressively bought back $300 million of common stock in just Q1 of 2026. But, and this is a massive but, despite passing all those business quality tests, Buffett strictly demands a margin of safety. Right now, Howmet trades at a lofty 62 times earnings. To get that Buffett-approved margin of safety, usually an entry multiple closer to 15 to 20 times earnings for an industrial stalwart, he likely wouldn't even look at buying until the price drops down to around the $137.99 mark. It's a phenomenal business for sure, but for Buffett, the current price is just way too hot. Shifting gears to Peter Lynch, we can easily categorize Howmet as a classic fast grower. They are perfectly leveraging both the aerospace supercycle and the global AI infrastructure boom, which, by the way, drove their gas turbine business up 25%. But Lynch would immediately spot two huge red flags. First, institutional ownership is massive, sitting at over 90%. Lynch loves hidden gems that Wall Street ignores, and Howmet is definitely not being ignored. Second, there's been some recent insider selling, notably an executive vice president unloading over $11.3 million in shares. To really figure out if we're paying too much for this fast grower status, we have to use Lynch's absolute favorite metric, the PEG ratio. That's simply the price-to-earnings ratio divided by the expected growth rate, and it tells us the exact trade-off between the price we're paying today and the growth we're getting tomorrow. So if we assume the current PE of 62 and a projected EPS growth rate of roughly 34%, since analysts project earnings to hit $5.05 per share in 2026, Howmet's PEG ratio sits at roughly 1.8. Peter Lynch strongly prefers a PEG ratio of 1.0 or less to indicate growth at a reasonable price. So at 1.8, that growth is already heavily priced in. That gives us a Lynch-style hold opinion. Section 3, the Graham lens. It is time for the ultimate defensive test. Benjamin Graham, the absolute father of value investing, uses a super strict defensive investor checklist. Howmet easily passes his tests for adequate size with its massive $109 billion market cap, and it passes the strong financial condition test with a really healthy current ratio of 2.44. But it miserably fails his strict pricing criteria. Graham wants a PE below 15, Howmet is at 62. Graham wants a price to book below 1.5, and Howmet trades far, far above that. To find his exact buy price, we calculate Graham's legendary intrinsic value formula. That's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. And we're being generous here, using the 2026 projected EPS of $5.05 and a calculated book value per share of $13.77 based on their latest equity figures. And wow, this really highlights the extreme conservatism of Benjamin Graham. Even without a margin of safety, his formula dictates an intrinsic value of just $39.55. For a pure, unyielding Graham value investor, this is a definitive sell. Graham simply does not pay premiums for future growth supercycles. He pays for hard assets and current earnings. Period. Section 4. DCF Valuation. Let's look at those discounted cash flows.
To project Howmet's future cash streams, we built a base case DCF model. We're using a 10-year forecast period and a starting free cash flow base of roughly $1.5 billion. That lines up perfectly with management's ambitious targets and their recent $1.8 billion acquisition of CAM, which is immediately accretive. We're applying a standard weighted average cost of capital, or WACC, of 9% for large cap industrial, and we're assuming an optimistic perpetual terminal growth rate of 3% to account for the massive defense backlog.
But here is the crucial takeaway. Even under some incredibly generous growth assumptions, like flexing the WACC down to 8% or pushing terminal growth to 4%, the DCF just struggles to generate a fair value above the $160 to $180 range. The harsh mathematical reality of discounted cash flows tells us that today's market price of around $276 is extremely stretched compared to the actual cash the business is projected to generate.
Section 5. Market multiples. Let's see how the broader market is justifying this premium.
The market is clearly pricing in a massive best-case scenario here. On the bull side, Howmet is benefiting big time from airlines flying older planes longer due to new delivery delays, which is exactly why their high-margin spare parts revenue shot up 33%. Plus, their gas turbine business is catching a huge tailwind from the AI data center power boom. However, the bear case is very real. You've got Airbus supply chain bottlenecks, major labor shortages, and super volatile titanium prices. Any of those could easily throttle the OEM production rates that Howmet relies on. Let's flip the script and run a reverse DCF analysis. Instead of forecasting cash flows to find a price, we take that current $276 price tag and ask the model, what kind of growth is actually required to justify this? Well, to make the math work, Howmet would have to grow its free cash flow by an astronomical 20% every single year for a decade. That is a tall order. Even the notoriously bullish Wall Street analysts have a consensus average price target of roughly $227, which is still well below where the stock is trading today. Section 6. Synthesis and verdict. Time for the final analysis. Blending all these insights together tells a very, very clear story. Operationally, Howmet Aerospace is a fundamentally flawless business. They are executing perfectly, expanding their margins, shrinking their debt, and completely dominating their market niche. But the sheer mathematics of these legendary frameworks, from Buffett's strict margin of safety to Lynch's PEG ratio, Graham's asset test, and our own DCF, universally flag this stock as severely overvalued. Because the business itself is so incredibly strong, our final verdict is a solid hold if you already own it and are just riding the momentum. But it's a definitive wait for new money to enter. The margin of safety is simply non-existent at these levels. Given the extreme premium the market is currently placing on Howmet's flawless execution, it begs the ultimate question for you as an investor. At what price point does the math finally make sense for your portfolio? Do you demand that strict $138 Buffett margin of safety, or would a dip to the $160 DCF fair value be enough to get you on board? Thanks for joining me on this explainer, and keep running the gauntlet on your own portfolios.